As investors, we are currently experiencing very volatile markets and very rocky times. The stock market is crashing, stocks are being sold off. I know for sure that a lot of my stocks in my portfolio are currently in the red, and I'm sure it's the same for you guys. It seems to be that the growth stocks and the tech stocks are the ones being hit the hardest, but this seems to be across the board really, and I know a lot of you guys are really worried, but honestly, it seems that there is no need to be. If anything, you can view this as a buy-in opportunity. But I want to address some of these things in this video today. The majority of good companies can and will ride out these market corrections that we're currently seeing. Now, some sources are telling us that we are experiencing what is called a stock market correction. Others are phrasing it more as a stock market crash, and that we are going to be experiencing this for the foreseeable future. Stocks and the stock market are going to keep going down, and who knows when it will recover. I'm hearing all of this from different sources. So we're really talking about the difference between a market correction, which can just happen over the course of a few weeks, a few months, or a really hardcore bear market, which can happen for months, years, and sometimes even decades. So let's just quickly define the two. Market corrections are when stocks are down from all-time highs by about 10%, whereas bull markets are when stocks are down from their all-time highs by at least 20%. With that out the way, let's take a look at what tends to happen after the stock market goes through corrections and crashes, as I think this is really important to actually look at the data that we have in order to perhaps calm your anxiety down a little. Corrections can cause a lot of anxiety, and lots of people, especially if they're beginners, can really panic when they see a correction for the first time, and perhaps even will go on to sell out of all their positions and run away from investing for a good few years. And whilst this is understandable, I think it's also important to have a look at what historical data can really show us before you make a decision like that. I think it's really important to note that quite often financial markets will reach all-time highs and then they will see some sort of significant pullback. So this means that an all-time high is reached and then the price will plummet slightly whilst there's a pullback and a little market correction takes place. Now, more often than not, this will happen at a certain period of the year, and then the rest of the year you'll see positive returns. So let me give you an example that I've got noted on my laptop here. In 2018, the S&P 500 saw a market correction of more than 10% in its first quarter of the year. If you were investing during that time period, it might have been quite scary and somewhat similar to the situation now. And this happened again in the fourth quarter, but then this was followed by a rebound of more than 13% in the first quarter of 2019. So that's just demonstrating that these market pullbacks, these market corrections happen, and then more often than not, the time following will see a positive return. I spoke a little bit earlier about the differences between a market correction and a bear market. Now, nobody can predict whether a market correction will go on to turn itself into a bear market, which means that the all-time high prices are down by at least 20%, and nobody can really tell whether that's going to happen or not. Quite often, the market correction will happen, prices will be pulled back, and then it will just go on to carry on as normal, and prices will rebound and we will see positive returns. However, there's been occasions where a market correction has happened and this has led into a bear market, times when the price really does go low for perhaps longer periods of time. What I will say is most historic market corrections have not gone on to be bear markets. That's not to say that this doesn't happen, it's just to say that more often than not, this doesn't happen. I've got some data here on my laptop and I'll put it on the screen as well so you can follow, but let's just go through this because it's really, really interesting. And, you know, looking at the data and what's happened in the past doesn't predict the future by any means, but it's something that you should know about as an investor, especially when there's a lot of fear going on right now. So I'm having a look here and it says that there have been 24 market corrections since November 1974. And I believe this is just in the S&P 500, but I could be wrong. But anyway, 24 market corrections since 1974, and only 5 of them have become true bear markets. So that was a bear market in 1980, 1987, 2000, 2007, and of course 2020, which we all know and love. So in other words, there has been about a 1 in 5 chance of a market correction turning into a true bear market. And although 1 in 5 is still pretty significant, it does show you that this doesn't always happen. Another thing that I see quite often is people worrying that we are going to enter a bear market and this is going to last absolute decades. So we're going to see periods of 10, 20, even 30, 40 years where we're going to see our portfolios and our stocks just trade sideways or even worse, lose us money. Now, I'm not saying this can't happen. Of course it can happen. We saw that happen in the Japanese market, which I'll touch on in a bit. But typically, past performance has shown us that a bear market tends to be shorter than bull markets. I'm going to look at some data now, and again, I'll pop it on the screen. So what this is showing us is the average duration of a bear market versus a bull market. So in blue, we can see all the bull markets, and in red, we can see all the bear markets. And just the size of the bars shows us that the bull markets tend to be a lot longer than bear markets. So just for some comparison purposes, this big one here, this big bull market, lasted 4,494 days, and the return was 582%. Whereas if we compare it to this little bar next to it, it lasted 29 days, compared to that 4,494 days. So you can just see, just taking a brief overlook at this, bull markets tend to be longer than bear markets. And I think that's really reassuring for a beginner investor that is experiencing this market volatility for the first time. Let's just take a look at what some of the largest indices are doing at the moment. So we'll start off with the S&P 500. Over the last 1 day and 5 days, it's been positive returns. Over the last 1 month, we've had a negative return on the S&P 500. So it's down by 7.5%. But if we go back to 1 year time period, we can see that actually, although we are trending down, we've started to regain some momentum here at the very end, the end of this graph. I don't know if you can see that. And it looks like it's going to continue, but we really don't know. We can't predict the market. If we max out this graph here, what you start to see is that what we are experiencing now is really, really small in the grand scheme of things. So if I pick any one of these dips here, what we can see, and this is a really common theme across everything I'm going to show you, the market rises. The market always increases over time. I'm sure people that bought here and then saw their stocks go down by 40% during this time period were freaking out, especially new investors that didn't really have the experience of market volatility. They were probably freaking out and worrying, should they sell, should they hold, have they invested in the wrong stocks? But actually, what happened after? The market carried on. The market started showing us positive returns. The market rebounded. Yeah, not by much. If you look at these two peaks here, these two all-time highs, they're probably not much in it. So 1,452. So there wasn't much in it. But again, if you dropped here and you freaked out, if you bought here and you sold here, you would have then kicked yourself, because look what happened after. It went absolutely crazy. So what I'm trying to say is all these little dips that we see, they don't always escalate to be something crazy. Even if this market situation that we're seeing now carries on and the market drops by, let's say, 30%. If you're a long-term investor and you hold on to that, chances are, and I'm not a financial advisor, so I'm not telling you this as financial advice, but looking at the past data, chances are the market will rebound. Let's just have a look at the Nasdaq now. So if we have a look at 1 day, it's up, 5 days, it's up, 1 month, it's down by nearly 13%, 6 months, it's down. And we can see that if we again go to the 5-year time period, over time, it does go up, and max it out again. Wow, this one is quite a curve. Let's just say that in 2020, you as an investor hadn't experienced market volatility before, and you then brought in at this point, 7th of February. By the 28th of March, the market had really dipped. You can see that here, it's gone down by quite a lot. If you were patient and you put that money into investments that you didn't need, it wasn't your emergency fund money, so you were happy just to leave it doing what it needed to be done, and you understood that the market will increase over time, you'd have then been seeing positive returns over the next few months and the next year or so. And let's have a look at the QQQ now. 1 day positive, 5 days, 1 month. Again, this is very similar to the NASDAQ. But we're seeing the same thing. We're seeing that, 1 year it's not done so well. It's kind of traded sideways. 5 years, again, it's gone up. Max it out. You can see that over time, it goes up. So I see two options for me as an investor. I see two situations happening. One situation is that we are experiencing a market correction and people will do one of three things during this. They will either sell their positions and run away from the market. They will just hold and sit back and watch the market and do absolutely nothing and leave their money to do as it pleases and just trust that in the long run they will see positive returns and the market will go up. And three, they will invest more. So they will see it as a buy-in opportunity. They will buy their favorite companies, their favorite ETFs at a lower price than they normally would be able to buy them for, which of course means that if the ETF or the market then goes up, they will get more gains. And the other option that I see that could possibly happen is that we will enter a bear market and perhaps even a recession. Maybe times will get really, really tough in the stock market. As I've said, we can't really predict this, but it's possible. Of course it is. And this is really scary, especially if you've not experienced anything like this before. Like I haven't. I've experienced the crash that we saw in 2020, but other than that, I've not really experienced much, and to be honest, my portfolio, more often than not, has been in the positive returns. And I said that I'll mention the Japanese market again, and if you take a look at the Japanese stock market, what happened is they went through a big crash and they didn't really recover for 30 years or so. They just traded sideways. So that could happen again. Like it has happened before, whereby decades have gone past and prices haven't really increased and the stock market hasn't really recovered. And I guess if you truly believe that this is possible, then you may consider selling out of your positions. You may consider rebalancing your portfolio. You really need to analyze your risk profile, your age, how long you want to be in the market for, and all of that stuff. For me, if this did happen, then I would probably just hold my positions, if not buy in more, because I'm in this for at least a few decades, if not longer, I hope. So I don't really see it as something that I would need to worry about. Of course, it would be sad if I just suddenly started investing and then I had a period of 30 years where my portfolio didn't do anything. That is not optimum. And of course, I would look for other investment options outside of the stock market that may be more, may return more for me, but I would still invest and I'd still hold and stay within the stock market if we saw times like that happen. But I'm by no means jumping to this conclusion. I'm not saying this is going to happen. I want this to be a positive video and I want to reassure you guys. I just want to also be transparent that, of course, not everything is dandy all the time. So now let's just talk about what you should do now. Really worrying about a potential bear market is a little bit counterproductive in the sense that you could sit there worrying about your portfolio for ages and ages. You could sell out of positions, run away from investing, only to find that 2 months later, we're in a bull market, the stock market's booming, and you've missed out on a lot of unclaimed gains. However, having said that, it's always good to have a sort of strategy in the back of your mind that you could put into place should you need to. And the reason it's so important to have somewhat of a strategy for good times and bad times is because you want your investing to be very strategic. You don't want to base your investing decisions on emotions only. The first thing to do is to make yourself a financial plan if you don't already have one. So this plan will set out everything that you plan to do in all kinds of market conditions. So if we experience bull markets, bear markets, we trade sideways, growth stocks tank, whatever it may be, you have a plan ready to turn to. And this will really help ease your nerves because in times of heightened emotions in investing, you can just look at your plan and see exactly what you need to do. So let's say that we are experiencing a bear market, stocks are going down, everyone online is telling you to sell out of your positions. Your family, your friends, they're all freaking out. But you've written yourself a plan that says when a bear market happens, you buy into the market. You get your favorite companies at discount prices. Now, if you didn't have that plan in place, you may have also been very emotional and either not invested anymore or sold out of positions. Whereas if you have the plan in place, you know exactly what to do and when to do it. And it can really help calm your anxiety. The next thing to do is consider your risk tolerance. It's really easy when we see a bull market to invest loads and to feel really good because prices are going up. And then when you see a bear market, to not invest and to panic because prices are going down. But you need to establish how much financial risk you're willing to take as an investor. If you just don't have the risk tolerance to lose loads and loads of money when times are tough in the stock market, and you especially don't want to be investing during these times, then perhaps you need to rebalance your portfolio, add some more assets into your portfolio that aren't going down as much. So right now, for example, you might see that the tech companies are going down the most and growth stocks. If you don't have the stomach to stomach that, then perhaps you may look to move and rebalance your positions away from them companies and into some more stable companies. That's something that you need to consider. And leading on from this idea of diversification and rebalancing, you need to take your life stage into account. So if you're a really young investor that is considering being in investing for the long run, so decades and decades, then chances are if we see a market crash, you will be able to recover. You'll have time for your portfolio to recover from a market crash. Whereas if you're nearing retirement, you may not really be in the position to take them risks and you don't have time for a market crash and recovery. So in that case, again, you may want to rebalance your portfolio, move away from equity maybe and put your money more into bonds. There's lots of things that you can do, but yeah, that's definitely something to think about. If you want to hear more reassuring messages about the current stock market situation, then watch this video here.